Welcome, Richard Fisher, former Dallas Fed president, who's now a Barclays senior advisor and a CNBC contributor, and Julia Coronado, MacroPolicy Perspectives president and former Fed economist. Does the no tie, are you sending a signal to Jay Powell about something? Should we read anything into that, Richard? Did he call you and tell you what he's going to do?
I have no tie on because I'm about to get on a plane to go to Australia. So it's my travel gear, Joe.
You can't take it off after the hit. What do you think is going to happen today, Richard? Seriously, in your view, in terms of the Fed, we going to see something?
I think you have to look at the different parts of the toolkit, as Steve just mentioned. It's possible they won't move on rates, but they can do a lot of other things. And one thing you didn't mention, Steve, is perhaps activate or reactivate or expand the swap lines with countries that are having problems. So there are a lot of tools that can be used here. As Leon Cooperman pointed out, rates are already so low. I mean, the 10-year at 1%, Joe, Becky, that's the lowest rate for the key marker bond in the global trading markets in over 800 years. This is an astonishing thing to contemplate. Yeah. So money is cheap from the 2 to 5 year all the way out. The question is, what's the efficacy of cutting here? And as was pointed out earlier, do you want to spend whatever you have left now unless you're sure that it's actually going to have a huge negative impact on the economy?
So it's not just...
This reminds me, Joe, of 1987. We had a couple of sell-offs a week before Black Monday.
Yeah. They
were pretty severe, 12% in a couple of days.
Right.
Then we had a little bit of a pause. The Fed reacted then. Alan Greenspan reacted then. In fact, he landed here in Dallas to go to the Dallas Fed and then went back home, made all the right statements. And, of course, they had a little bit more in their toolkit to work with than we do now.
Yeah. I remember that day. I had one client that was, he was long bonds, I think, and he was losing his shirt, getting margin calls. And in that one day, he made it all back and then a lot more on, I can't remember how, we went from like 8% to, I don't, it's so long ago, but a huge jump in the bond market, like 3 full points, 300 basis points in one day.
But I do worry this thing is
300 basis points.
We're overreacting here. We're asking the Fed to do something that may not have the kind of impact that everybody would like.
Yeah.
And there's a hysteria out there. As you probably know, Corona beer, which is a big deal here in Texas, has had a dent in sales because of rumors that's a source of coronavirus. So this panic is a little bit out of control. The Fed's job is to be the steady hand, the mature person in the room, calm things down. I'm sure they will do something to calm things down. It may not be a significant rate cut, but they have all these tools that I'm sure they will use.
Julia, you're a former Fed economist. Do you have things that go along with what Richard's saying, or do you have some differences?
Well, I think both Steve and Richard sort of put their fingers on the fact that this is really a confidence game right now. It's not that the rate cuts are going to stimulate consumption when everybody's cocooning, as your prior guest said, in response to a virus. So there's very little they can do to address the hit to consumption right now. And it's more of a signal that we're on the case. So I sort of debate myself whether an emergency rate cut effectively endorses the panic in the market, or would it be better to go at the meeting and go in a more methodical process. There's no doubt they're going to cut rates and do what they can. But I think Steve also mentioned if and when it does spread and really hit activity in the U.S., what can the Fed do on the supervisory front to encourage banks to provide the liquidity to households and businesses that are going to see an interruption in cash flows? That's going to be as important as rate cuts.
Can we just go back to what you were saying earlier, which is one of the things I'm trying to puzzle out? There's a mechanical way to think about this, which is that the decline in demand, the decline in investment, the decline in growth lowers the neutral rate of interest. If that ends up being the case, then relative to where the Fed was, it is too tight, and so must come down to meet the new neutral rate. And if all you did was put that idea in a box and not thought outside that at all, you would lead to the need for the Fed to cut.
Correct. Absolutely. No, without a doubt, the Fed is going to be cutting rates. The question is, do you want to go sort of methodically at the meetings, gather information, recalibrate to what that neutral is? Because this thing isn't going to happen from one day to the next. This spread is going to happen over weeks and months. So what is the actual impact and how much do you want to recalibrate? Go 50 at the March meeting and then sort of evaluate as data comes in. So, I think
there's also a risk here that if they were to act precipitously, you could scare people. So
yeah,
I like
that's
the idea.
question.
And you and I both know, having been at the Fed, methodical is the way you like to approach things.
Hey,
Right.
Richard, is this time different, though? I just look at the market's pressure that it's put on it. And I was just asking Steve before, we always said don't fight the Fed, but is this a situation where
really good one.
the Fed's going to have a tough time fighting the market?
Well, that's the trap we created by going to ZIRP, zero interest rate policy, and 3 rounds of quantitative easing and leaving that on for 11 years. We knew that at the time it was a risk. And so I know, but this is a big trap now. We've never done this before quite like this. It's never been done before. And you don't want to be bullied by the markets. But on the other hand, we are in that position. So this is a very delicate thing to maneuver. And I know Powell is thoughtful about this. The committee's thoughtful about it. But if you're looked to always put a foot in the market, you can never get out of that trap. The real issue is the real economy.
To draw
the real issue is the real economy.